Here at GowerCrowd, we run paid advertising campaigns for real estate companies trying to find investors, and we cover just about every asset class that there is. And from that, we can tell what investors are looking for, what is driving their investment decisions, and what they like and don't like. And at the moment, there is one type of real estate that is clearly resonating with investors, and that is medical office buildings. Hi, I'm Adam Gower, and my guest today, Ben Reinberg, founder and CEO of Alliance Consolidated Group Companies, focuses exclusively on medical office buildings, which is what makes him an especially interesting guest today as we head into uncertain economic times. Ben has taken the art of real estate syndication to the next level by establishing a personal brand. It's actually really cool to see it emerge alongside and complementing his online educational strategy. And in today's podcast, you're going to learn more about medical office buildings and also more about how a personal brand dovetails into running a real estate syndication company. To find out more about Ben and Alliance, go to the podcast page at GowerCrowd.com. And while you're there, be sure to subscribe to our newsletter. There'll be a big button up there that says subscribe somewhere. Go ahead and subscribe. It's totally free. We have the only news channel that is exclusively dedicated to real estate crowdfunding and syndication. And you will get weekly updates on what's happening, who's doing it, and links to just about every real estate deal on the market, right? So go ahead, subscribe there at GowerCrowd.com. It's totally free. Oh, and by the way, I'm going to include a link on the podcast page to the ultimate guide to medical office building investing that we put together for Ben. It is absolutely fascinating, very detailed, and well worth the read. So you'll find that there again on the podcast page at GowerCrowd.com. That's it. It is now my great pleasure to introduce you to my friend, client, and increasingly famous personality in his own right, Ben Reinberg, founder and CEO of Alliance Consolidated Group Companies. Here he is. Ben, I'm so happy to see you. I'm so sorry you've not been well. I'm grateful to you for doing this podcast today. Despite that, we've got one question for you. My first question actually is, as you know, of course, we are running some campaigns for you to attract investors. Mm-hmm. And there is clearly way out there more interest in medical office buildings than any other asset class in the market at the moment. Why do you think that is?
Well, the reason why that is because we have the most safe and secure asset class in a world that's uncertain right now. Interest rates have risen like it did yesterday. It went up 75 basis points. It's been up 1/4 point over the last 30 days or so. And with rising interest rates, and uncertainty affects other asset classes in our business. Medical, the human body, I always say, is never going out of style. And with that being said, it provides stability. And when you have stability, it's very attractive in uncertainty, especially in these times. So our asset class, medical properties and veterinary properties, is very attractive to the investment community. And it's why we've had so much success from all the marketing we've run with you.
How did you get into it, Ben, in the first place? I know you've been in it since they invented medicine, as far as I can tell. You've been in it a long time, but tell me your background and how you discovered medical office buildings.
Well, about 28 years ago, I got into commercial real estate and started syndicating real estate and had a lot of success. And I'm an expert in industrial, office, and retail. And with the internet, we were really bullish on retail for a long time. And with the internet coming around, we kind of moved off that and said, there's a lot more risk than with stores closing. There was the retailers weren't expanding, they're contracting. Industrial was subject to different administrations in our country. We weren't manufacturing, so there wasn't as much distribution. So we had a look and we said, well, what's really a niche that's growing and stable and we could provide a lot of value to? And that was the medical office space. We started acquiring medical office about 17 years ago, and we've been running ever since.
Tell me a little about what is a medical office building, or what are the different kinds of medical office buildings? Like somebody, that doesn't know really what this asset class is, give us, the high level overview of what this is and how it's different from other office type of real estate.
Well, medical office, and we'll speak in generalities because there's all different types of buildings. Generally speaking, it could be anywhere from a single tenant to a building where you have multiple medical tenants in a building. And with that being said, we look at both type of opportunities. The difference between medical office and general office is general office could be, you might have a single story office where it's leased to a law firm or a business. It could be multi-tenant, like the one we're in Bankburn, Illinois, where there's a bunch of different tenants like us. It could be real estate companies, attorneys, insurance companies, title companies, etc. So we're non-medical tenants in that specific asset. Generally speaking, with the medical tenants in medical buildings, there's a significant amount of investment that goes on, and there's a lot of different niches in the medical space. It's why we're so bullish on it, because our tenants dig such deep roots that it's very difficult for them to move. They serve a purpose in the community, and the renewal rates are in the upper 80s on a percentage basis around the country. That's an average. And with that being said, it provides us predictability in our cash flow streams.
Now, you mentioned it ever so casually, but it's a big deal, isn't it, that your tenants invest a lot in the space that they're in, right, with equipment? So why is that important? That what does that mean for an investor as far as the longevity and security of their investment?
Well, when you have a tenant that has a tremendous amount of investment, they don't want to move. They're building roots. Their revenue is generated off that real estate and that location and based on the services they provide. So when you have a piece of real estate with a tenant, like a medical tenant that invests so significant into their space, when it comes time for renewal, you have a higher probability of renewal. So what that offers investors is stability and the ability to add value to the income stream. Might be a longer term lease, might be able to increase rent, might be able to sustain different cycles going on, like the one we're probably about to go into and potentially a recession. So medical tenants provide a lot of stability. And when they invest in their space, they do not want to move. It's too costly to move. And that has a huge impact on making sure that you can provide a secure investment to your investors.
Right. And that's equipment, isn't it? But it's also because you have this not customer, patient base that is in the hinterland of the location, right? That's also important.
Yeah, it's very important. And it's not only equipment, it's electrical. We have tenants that put in generators outside their buildings, the lighting. There's so many nuances and variables that they invest in for their particular business, depending on what they do. The power, the way the floor plan is laid out for them and how it moves and how it protects patients. So there's a lot of little nuances that you have to look at that are in addition to just the equipment. It's how does that space function for that specific medical tenant? And that's really important. How much parking do they have? There's a lot of little nuances that go on at these properties that we understand, and what helps us assess an investment to say, hey, this is a real safe, secure, and potentially profitable investment.
Now, you also mentioned the times that we are in, right? Clearly, there's a lot going on in the economy at the moment. We've got 40 plus year high inflation, interest rate hikes that are the highest for decades, potential for recession, bear market in the stock market. How does medical office perform during this kind of economy?
Well, medical office should perform very well. The pricing will mirror interest rates. And so that will kind of balance itself out. Pricing will drop for the cost of these assets. They'll have to with the cost of capital going up.
Mm.
But at the end of the day, like I said earlier, the human body is never going out of style. And with that being said, if you think about it, all of us need to go and still use medical services. We had to during the pandemic, we had to before the pandemic, and we will have to afterwards. That's the one of the nice things about our investments is we have a foundation that's the human body that is the generator of the services that our tenants provide. So at the end of the day, it's why our investments are safe and secure, and the recession and pandemic proof. Our tenants pay rent during difficult times because people are still have to go to the doctor, and insurance companies will cover a proportionate share of some of those services. And so at the end of the day, people feel very comfortable because they feel comfortable spending money knowing like, hey, if I have insurance, they'll cover part of the cost. It won't cost me as much. I'm not feeling well, or I have to go get a colonoscopy, or I have to go get cardiology services or dialysis. There's certain services that our tenants provide that are allow people that are so critical to their lives and every day. And so whether it's pediatricians to dialysis to oncology to gastroenterology, the list goes on and on. Us and all our family members use all these services, and it doesn't matter what's going on in our environment. That's why I like what we do, because there's a real barrier that covers what I call outside environmental influences in our product type. People still need to go to the doctor. Their telehealth is wonderful, but not with the services that our tenants provide. You still have to go to the doctor and show up and use their services, a very physical, inpatient type use.
Now, there are some interesting industry dynamics as well, aren't there, in the medical office industry? One of those is the note that I've written down. I'm not sure if it's quite the right note. It's the institutionalization of the industry. So this is where large institutional scale entities are buying these small practices and kind of leaving the real estate as a second thought. Tell me something about how that provides you guys with opportunities, and what does that mean, again, for your investors?
Well, we've seen that a lot with our tenants. I would say over the last 5 years, we've seen a lot of merger and acquisitions in the industry where our physician groups, we might own a property. It could have been a sale leaseback transition. We might have bought it from existing physicians that own the real estate. And what ends up happening is a lot of the hospital systems or larger conglomerates are coming in and buying that physician group out. So for us, what's fascinating is it opens the door for lease renewals and also for what I call a credit enhancement. Basically, you end up with a better tenant on your lease, which adds a lot of value. So for us, the merger and acquisition has really been a positive thing for us because we've allowed to add value to our properties by renewing leases with a new tenant. It could be restructuring a lease, and then also bringing on the new tenant, which generally speaking has better credit than our existing tenant.
Now, you put together that's a fascinating angle, actually. It's actually particularly the credit enhancement. That's interesting because now you have, instead of the doctor group or the physician group, you've now got a large entity that is your tenant, right? That's exactly what that means.
That's correct. And so it opens the door to add certain clauses to the leases. Like, for example, we might say with a new entity coming in, we want to be able to review their financials on an annual basis. Maybe we didn't have that clause in the lease. Maybe there's certain items in the lease that the new tenant's willing to take on that the existing didn't because they're better capitalized. And so there's a lot of variables that get discussed within a lease when an acquisition of a physician group goes on. And it's really become to our benefit. We've really been able to capture a lot of value from the process.
And you and I've been talking for a long time. Mm-hmm. You have some really, really cool stories about deals that you've done. Tell me at least one story, like a case study of one of these deals that you've done. I know you've got a few of these examples. Tell me one of them so everyone.
We have a lot of stories. When you're in the business long enough and you do enough deals, you see a lot of interesting things.
Mm.
One of my favorite stories we have was we used to own an imaging center in Columbia, South Carolina. And I love Columbia, South Carolina. It's the home of the Gamecocks, where the University of South Carolina is. And I got to travel there frequently. We had property in the region for a while. And we had this wonderful property that was an imaging center in downtown Columbia, South Carolina. The university was migrating towards our property. They're building a new law school, new development. It's a CBD area. It's a central business district area. So it's very dense. And what ended up happening is we bought the property from someone that needed to sell. They were in a situation. We took them out of it. We bought it for all cash. And when we acquired it, it was a very successful imaging center. A year later, it got bought by a large hospital system from the Southeast. I won't go into names, it's not relevant. Great credit. They wanted to renew, but their concern was parking. Their tenants had to walk across the street from a parking garage or walk down the street. It was a busy area. You had a parallel park on the street, and then you had to get out and walk to the front door. That could be 3-4 blocks away. Someone might be in a wheelchair. You'd have to pull up and block traffic. It was a lot going on. And so we had a student housing for the law school development going on, and we met the neighbor. And his concern was, he said, I don't want you guys going vertical, building 2 or 3 more stories above your building. And we said, okay, well, what do you want? And he told us what he wanted. He said, I'd like to consider an easement or buy the air rights above your building. So we took a step back and we said, well, what does our tenant want to renew and what do we want? Well, they control the parking lot behind us. It was about 30 parking spots. And that parking lot was important for us because our tenants could park there and walk right to the front door. And a little solidity like that adds a lot of value. So what we did is we did what I call horse trading. We said, we'll create an easement above our building for the air rights. We won't build 2 or 3 stories above, but we want 20 of your 30 parking spots, and we'll do a trade. And that's what we did. We worked out an easement agreement, parking spots for the air rights. Worked out really well. We were able to extend our tenant for an additional 10 years, and we sold that property for a wonderful profit. So we took a challenge and said, how do we fix it? How do we help our neighbor? And it became a win-win for everyone involved and ended adding a tremendous amount of value. Our tenant was extremely happy, and we ended up selling it, and our investors did incredibly well on that asset. I mean, that's just one of many stories that we have, but that's one of my favorite ones because we had to take a situation where we controlled the air above our building and we utilize it to add value to our income stream, which I'm really good at.
It's really, really good. Making money out of thin air. I love that story, Ben. It's one of my favorites. It's really cool. Now, traditionally, you've done these deals on a deal by deal basis, and you have a lot of very happy investors. In fact, anyone listening, I encourage you to don't do it now while you're listening, but later go to alliancecgc.com, check out the testimonials from some of Ben's current and former investors. It's there, I think, under the About button. You'll find it there under the menus. But you've decided to move to the fund structure, which is a bit different from the deal by deal basis. Walk through the thought process of why you've evolved your company into a fund rather than deal by deal basis.
It's a great question. And we outlined 3 benefits to doing it. One, we've determined from a lot of the banks that we deal with around the country that the cost of capital is better with a fund. We have a lot of ability to get incredible financing from our lenders having a fund structure. So the cost of capital gets reduced. We could do subscription lines of credit. We have the really ability to really go shopping when we look for debt with a fund. So that's number one. Number two is the buying power. When you go out to the brokerage community or the selling community in our space, especially in the medical and veterinary and property space, they know how much money we have to spend. And because we can move so quickly, we also get better buying power. What I mean is better pricing on deals. So a $5 million purchase price might end up being $4.5 million, knowing that we can close, we can move quickly, and there's not a lot of red tape to get deals done. Well, that's very attractive to sellers saying, I'd rather do business with Alliance and take their price and then take a flyer with someone I don't know that maybe will pay me a little bit more. So the buying potential is tremendous with a fund. The third thing is also diversification. A lot of our investors have asked for, can I take my 500,000 instead of being over 5 deals? How about we put it over 25 deals? So we took a step back and we listened to them. We said, it makes a lot of sense. So the diversification is tremendous as well. We have a great track record with our investors. So to have a $500,000 commitment to be over 5x what we normally do with them is a tremendous benefit. So we learned and we said, with the ability to scale faster for our investors, acquire properties quicker, better cost of capital, and diversify them, we said, why haven't we done this in the past? And so for us, it's a great step forward. It's a great vehicle for our investors. We don't have to hassle them. They sign one set of documents. They get one K1. They don't have to review every deal. It just makes their lives easier. We do a simple capital call. They fund it. They're done. The property's in the fund. They're enjoying the returns. It's basically one big syndication, the fund. The only difference is that you have one vehicle that owns all the properties. And so we felt that it's a better structure overall, has a lot of benefits to our investors, has a lot of benefits to Alliance's employees. And we felt that we want to be able to offer the best product out in the marketplace to our investors. And I believe that's what we've created with this new fund.
Now, I know that you've got a really good deal pipeline. You've been telling me something about these. It's really interesting to hear it. Tell me something about what are the key characteristics when you're looking at a deal. What are the key characteristics that you look for that gives you a green light to dig a bit deeper and to move forwards with a deal?
Well, to start is we look at certain areas of the country, and those areas have high population growth, good healthcare policies, have had great economies through different cycles. And that has to do with the South, the Southeast, the Southwest, Mountain West, and parts of the West Coast. Those areas historically have done very well with our product type. So that's where we look to invest our capital. And then we go a step deeper and we say, okay, well, what kind of properties are we looking for? Well, we invest in single tenant net lease medical to usually up to 7 or 8 tenants per property. And they're all net lease, okay? So we don't buy gross leases, that's number one. Number two is, in our criteria, we look for 50,000 people in a 5-mile radius. The reason behind that is density. You lose a tenant, we want to make sure we have enough population to draw from, that our medical tenants have services for, that we can replace that tenant. That's part of the methodology. We look for rent growth in the initial lease term to deal with inflation or rising costs. So 50,000 people in a 5-mile radius, we look for rent growth in the initial lease term. And then really importantly, we look for significant investment in the property by our tenants, which shows us that they're building roots there, that they have a significant investment and a higher probability of a renewal. We also look at the credit, the default risk of each tenant in our buildings, looking at assessing that they could pay rent and the income stream is going to be stable. We also look at where they're located. We look at how much parking they have. Is there enough parking to sustain them for a long period of time, or if we had to replace them? We look at the physical improvements. How is it built? What's the ingress? How do you get in and out of the property too? So we look at all these factors and then we assess, okay, how do we value this asset? And if we could mirror a value that works for us to what the seller wants, then we'll have a successful transaction. generally speaking, we don't put deals under contract that we don't close. There's enough work that goes in up front to know this meets our criteria. It's very rare we're going to have an environmental issue. Generally speaking, our properties appraise out very well. They're pretty solid income streams. And so that's what we look at. And we look at the cost of capital, we look at the risk. And from our analysis, we put it into what we call our stew and look at, does it work for us? And if it works for us, then we put under letter of intent, then we go right to a contract.
And you know this industry so extremely well that sometimes you gloss over. I'm just straightforward because I want to bring this up because you said something incredibly important. I want you to explain it a little bit. You mentioned the term net lease, OMG. In times of inflation, when costs are going up all the time, why does a triple net lease hedge inflation just perfectly for your investors?
It's a great question. I'll give you an example. So our headquarters are in a multi-tenant building in Bannockburn, Illinois. We're on a gross lease, okay? The reason why I'm not a fan of especially suburban general office is because your rents, your expenses are going up, your rents are staying the same, so your margins are constantly being pushed in a direction closer to zero or negative. With net leases, the tenants, either you pass through all those expenses to them. They might reimburse you or they might pay them directly. So if you acquire property and taxes are going to go up or insurance are going to go up, the tenant's going to absorb those increases. And when the tenant absorbs those increases, well, guess what? Yeah, you have to be very mindful of your net rent, but the tenant's absorbing those increases, not the landlord. And when the landlord has variable costs like that, it's very hard to predict your cash flow, your net cash flow. So net leases are so critical. It's the only reason why we look at net leases. We don't get involved in modified gross or gross leases. We want our tenants covering all the expenses and any of the increases as well. And that's why we look at it when you have a net lease and your tenant is paying all these increases as well as the investment in the property. Well, guess what? It makes it very challenging for them to move. And that's what we want in our income streams.
Perfect. One last question on the types of deals, characteristics. What is the kind of range of dollar size that you look for, that you like to focus on in terms of assets that you buy?
Well, especially for the fund, this new fund, and generally speaking, historically, we look between 3 million and 25 million per each acquisition. There's a reason why we do that. It's very important to us. One is diversification. Two is we want to play underneath the large institutions, and those dollar amounts lends itself to it. And so it's our job to accumulate a portfolio. That's what we're looking to do. And by doing that, you pull together some great assets and create enough mass that the institutions or the larger folks that play in larger spaces than us will end up buying our portfolio from us. That's the real opportunity for us.
Right, let's move to a couple of more personal questions. It might not be personal, though, I'm not sure.
Sure.
But it seems to me that you didn't get the memo that everybody is leaving California, but you have barreled headlong into California, moving from Chicago. What? Tell me, what on earth is all that about? While the whole of California is vacating, you're joining us. I'm so happy that you are, of course,
Yeah,
but tell me why.
I'm also a CPA, so I think I might have hit my head. Look at the logic behind it, but coming from Chicago, I'm a young guy that has dealt with snow and ice. Woke up. I used to go to, I would go to work. It would be pitch black. I would go home. It would be pitch black.
Oh.
And work, when you come from Chicago, it's a very heavy work ethic. And I was working 12, 13 hours a day. I was working Saturdays. And I have two sons in college out here. And so we live in Orange County area. My boys go up to school in Los Angeles County. And I have a daughter who goes to high school down here. And I think the push with my family was a change. We have a lot of family out here.
Mm.
Uh, I was commuting for a year and a half from Chicago to California. My wife and three kids live out here. And it got to the point where we said, we're going to open up a satellite office here. We'll keep our office in Chicago and we'll have a satellite office in Chicago. And then we have offices in different areas of the country. And I just felt that to make my life easier, instead of moving to Nevada or Arizona and to continue to commute, I wanted to make my life simpler. And I felt California was a great place. There's a huge commercial real estate market. There's a lot of brokers out here and people we do business with. There's a very significant amount of high net worth investors out here. So I felt that between the cost of living and taxes would be offset by the business opportunities that would arise to help grow our business. So that was a decision. And when you could wake up every day and it's blue skies and there's no potholes in the road here, it's a different way to live.
Yeah.
And it's a different mentality. So it's something I'm getting used to. It's a little bit slower out here than I'm accustomed to, but maybe that's to my benefit, is to be a little bit faster pace and add value.
Mhm.
And by doing that, I've had a lot more opportunities. We launched a podcast that is doing extremely well. I'm building my personal brand. I'm giving back a little bit. We're creating some course content in the commercial real estate space. And I wouldn't have had those opportunities if I didn't come out to California. There's a lot of people that are very active in the personal brand space. And so my social media has grown and I'm kind of stepping out of my comfort zone and doing different things. And all that stems from changing the energy and moving from Chicago to come out to California. So I'm really excited. We're opening up an office in Newport Beach in literally a month. And I'm really excited. I'm going to have a new life. I'm going to have a different commute. I've never commuted that far. Usually my office is anywhere from 5 to 7 minutes. It's going to be 20, 25 minutes. And, but it's going to be in a great area with wonderful people. And I'm really looking forward to it. So for me, it was a healthy change. And it took a lot of thought to move to California. But it was one of these moments I said I need to change. And some of my staff members wanted to come out here as well. It's very exciting for them.
Mm.
I think when you come from Chicago and you see what we go through with the weather and the challenges and the cold and the ice, and then you come out here, it's really been a blessing for the people that work at Alliance and allows us to do some other things. It is challenging with the time zones and all the different time zones we deal with. Being on the left coast, I get up extremely early right now, but my days can end a little bit sooner than I'm accustomed to. I'm usually used to working till 6 or 7. On the West Coast, I could finish by 5 and it's already 8 o'clock on the East Coast. So no one wants to really talk to me anyway. So at the end of the day, I'm changing a little bit the way I work, and it's exciting for me. So it's been a big change, but it's a very positive change. I think my family is thrilled that I'm out here. So,
you mentioned the personal brand. Before, I got to tell you a quick joke. And you mentioned the commute. You know why it's called? So for those who are not in California, one of the main freeways here is the 405 freeway. You know why it's called the 405?
No, why is it
Because
called?
whenever you get on it, it takes you 4 or 5 hours to get anywhere. That's what they say. 10 lanes of completely stopped traffic in both directions.
What's interesting is they have, so they call them freeways. We call in Chicago and Illinois, we call them expressways. In a lot of areas around the country, call them expressways. Here they call them freeways. And now I understand. So there's a tollway that I could take to work, and it's interesting how much they charge you. Now I know why they call it freeways. And they call the tollway what they call it, because the tollway is so expensive.
Yeah, it's definitely not. That's right. It's not a freeway anymore. All right. So I got 3 wrap-up questions.
Sure.
Quick fire wrap-up questions. But before I get to those, one last question. Personal brand. You mentioned this, Ben. This is one of the coolest things I've seen anyone do from scratch. We have a lot of clients, and no one's built a personal brand. Tell me something about what is a personal brand, and what are the components, and why are you doing it? What's exciting about it? I mean, it is exciting, but tell me
Right.
what you like about it.
Well, I took a step back literally about 9 months ago to figure out what's my next life. I've been in commercial real estate a long time. I plan on being in commercial real estate. My employees have a lot more control over the running of the day-to-days. And I wanted to eventually step out of my business and more run it and let my employees run it, and I'll oversee it. And I realized eventually, what did I want to do? Well, I want to give back. And part of giving back is figuring out, well, how can I help people? I realized in commercial real estate, I felt, and this is my personal view, that it wasn't really being taught correctly. And so I had to teach myself the business. I didn't like how the older generation above me, how they were teaching the business. They really weren't teaching the business. And so a lot of people over the years have asked me, how do I get into commercial real estate? How do I assess a deal? How do I put together a team? And I realized I can offer a lot of value to the public. So I took this approach saying, well, I need to build my personal brand and become an expert in the community in order to then go to the next step, which is create content. So it's a process. So we started and we said, okay, well, to build the personal brand is let's create a podcast and let's offer value through the podcast. And as the podcast grows, I'll be speaking all over, as well as providing content to teach commercial real estate. We'll teach how to get started. We'll have content to discuss how to put together a deal. We'll have content of how to underwrite a deal. We'll have content of how do you find a deal and how do you capitalize a deal. So we'll be going over all these different type of situations to offer value to the public. And so that's part of the personal brand building. The other thing about the personal brand is it helps alliance. As I'm out there building my personal brand, it naturally will help attract additional investors, more opportunities. It becomes free advertising over a course of time, and that really strengthens the alliance brand. The alliance brand is really part of my personal brand at the end of the day. And so we've learned that when you strengthen the Ben Reinberg personal brand, it naturally strengthens alliance. So I felt that the investment was good for my employees. It was good for me. It helps me do what I want to do. And so it was something important to me. So we started off kind of slow, and the podcast is taking off. We're booked through, I think, the end of August already. And we're heading into September. We're going to be booked through September eventually shortly. And so it's great. I have a studio, guests can come in. We do virtual like you and I are doing. And I have a team of people helping me. My social media has just exploded. You have to realize I wasn't on Facebook. I wasn't on Instagram. I had maybe 20, 30 followers on Instagram. Now I'm almost 11,000. I'm getting there. And that's in less than 90 days. So we took a step back. We're doing it right. We're going to add a lot of value. And that's what it's about. And I felt that it's a good time for me to give back. We can capitalize it on as well and make it a business as well. And I felt it was good for my employees. And my employees are enjoying it too, because they're seeing me get out there and add value, and it's inspiring them, and it shows them that, to get out of your comfort zone and do some unique things. So it has a lot of benefits to it, and it's been enjoyable. And other than that, I mean, I look forward to speaking down the road and really enhancing the brand and helping people and creating different revenue generators for the company as well.
Let's wrap up with 3 final questions.
Sure.
Rapid fire questions. First, Ben, what are the key daily habits that you have that make you successful?
Well, I've been doing this since I was in my 20s. I wake up and I go work out. When I was younger, I couldn't afford a trainer. Now I can. So I go work out with a trainer. In California, I do it about 5 days a week. I usually work out about 6 days a week. I make it religious. I get up. I go to bed at a very similar time. I go to bed as early as I can. I limit the amount of drinking I do during the week. I might have a drink on the weekend. I collect wine. So for me, I enjoy a glass of wine. Uh, those are some of the habits I do on a daily basis. The other thing is that I'm a big note taker. I write down what I have to do for the day on a yellow legal pad. And I'm a very simple person, but I do that and it works. And the other thing I do is I work Saturdays, and a lot of people don't. They think I'm crazy. So I'll work a half day on Saturday or a few hours. I do it to kind of figure out, what am I missing? What do I need to do? Get back to people, whatever I need to. I've done a lot of deals in equity raising on weekends, so I've had a lot of success, and that's been part of my routine.
Second of the last three questions. What's been the hardest lesson you've learned in real estate?
I think one of the things when I was younger, what I learned is don't rest on your laurels. You do a deal, you get a large sum of money in, you get lazy. And I've realized that those are the times you have to put your foot on the gas pedal. You got to take advantage of when, you got money in the bank and you can take advantage of things. The other thing I've learned is to bring on great people and spend time finding great people. When I was younger, I didn't really understand that concept. I thought it was all about like how to save money on employees instead of bringing in the best talent. So I also learned that to invest in people in the business.
Last question. What, for somebody thinking of investing in medical office buildings, now they may be an investor in other real estate asset classes, or may not be an investor in real estate at all, but they're thinking about investing with you in medical office building, what advice what should they keep in mind? What's the most important thing they should keep in mind?
Well, the most important thing that if someone wants to invest in medical office is do your homework. The niches, every single niche in the medical space has certain ways to underwrite the real estate. And that's why people invest with us, because it's extremely complicated. Every single sector in the medical industry has different underwriting standards, whether it be how many days they're open per week, what type of licensing do they need at the specific property. The list goes on and on how complex it is. So I always recommend, if you want to get in to invest in medical office, you invest with someone like us. That way you don't, because you have to say to yourself, well, where do you spend your time at the end of the day? Is this a full-time business for you? Because being in the medical property space, you will only achieve success for being and rewarded for focus. And if you can't focus, it's just too complicated not to spend the time we spend in this process.
And I'm going to sign off now. And I'm going to sign off with what you love to do every time. I know you do it. I'm going to do it for you. Ben Reinberg, founder and CEO. Telephone number 847-845-2326. Email address breinberg@alliancecgc.com. Thank you for being on my podcast.
And if you want to learn more about me personally, go to benreinberg.com.
How could I forget?
And feel free when you go on alliancecgc.com, like Adam said, you can read testimonials, look at the About Us, and you'll get a good flavor of who we are and what we do.
A real pleasure. Thanks so much for joining me.
Hey, thanks for having me. I appreciate it.
That was Ben Reinberg, founder and CEO of Alliance Consolidated Group Companies. What an amazing story. I know you will agree with me that personal brand is really, really unusual. You don't see it very often, and it definitely drives attention. It's a very interesting approach to building a syndication company when the whole world has moved online. Kudos to you, Ben, for doing that. Right, that's it for this week's episode. Thank you so much for joining me. Be sure to go to GowerCrowd.com and subscribe there if you've not already done so to our newsletter. It is the only source of information on the net that exclusively covers real estate, crowdfunding, and syndication. It's totally free. It's a great newsletter. You get all kinds of information go ahead and subscribe there at GowerCrowd.com. All right, that's it. Thank you again, Ben, so much for joining me today. It's a real pleasure knowing you, having the opportunity to work with you and seeing your platform explode in growth. It's really satisfying to see that. And thank you, of course, to dear listener for tuning in. I hope you enjoyed learning from Ben, and I look forward to seeing you again next time. That's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.